Hi everyone to today's GFS meeting. Today we are going to present shortly what we are working on, and this will be like kind of introduction for tomorrow's seminar. Let's start. So Leah, can you present what you are working on?
Yes, Anetjan. Hello, everyone. So I have a little presentation. So I am Lia, and today I want to briefly discuss the labor market and the United States labor market of the United States, as we have recently observed some uncertainties and also some fluctuating risks in the labor market. So I'm working on this project now. I worked on this project starting from today, from the morning. And let's begin by understanding the current state of the US economy. So here I have an economic report card that provides an overview of collected and charted data. And you can see that despite job growth and consumer sentiment, many indicators do not suggest robust economic expansion. And in my we know that US added 272,000 jobs, yet the unemployment rate rose to 4%, and it's up from the April, it was 3.9% in April, and this gradual increase could indicate a slowdown in hiring by employers, though it remains below the 10-year monthly median of 4.3%. But another interesting chart that I want to look at, and I wanted to look at these surveys. Let's examine the payroll and household surveys on employment. So you can see that there is a notable divergence between these two surveys, and the payroll survey shows significant job increases, such as nearly 2 million since 2023 and 1.2 million just starting from this year. And I can say that this is highlighting a tight labor market. And also in contrast, when we look at the household survey, it indicates a more modest increase of 200,000 compared to last year, with a decrease of 300,000 since January, since the start of this year. And this is suggesting a cooling labor market, that maybe labor market can be weakening. And also another uncertainty is that here also you can see I also plotted the difference between these two surveys, and here you can also see that the difference, the gap is rising. So and then I looked at this Atlanta Fed spider chart, and we observe a wage data indicating tightening conditions despite being lower than 2023. It remains relatively high, but conversely, employer behavior data shows signs of cooling, suggesting a different trend. And additionally, analyzing GDP and wage growth data reveals ongoing wage increases despite cooling inflation, underscoring the persistently tight labor market. And however, the unemployment rate is on the rise of 4%, and the job opening ratio also is also increasing, indicating the labor market may not be as tight as initially perceived. Also, there are also another stories that I want to say, that healthcare remains a crucial sector here in the labor market, contributing significantly to job growth over the past 2.5 years, driven by an aging population and expanding insurance coverage through the Affordable Care Act. So also this is one story that is connected to the to this insurance, and another story that government employment has also exceeded expectations, recovering quickly despite initial expectations of decline. And third story that I want to say that President Biden's policy decision, particularly his focus on job creation and inflation management, are crucial as we approach the upcoming elections. These policies are, I think, pivotal in shaping economic strategies and sentiments. So, also in conclusion, I want to say that whilst some certain sectors have surpassed growth expectations, uncertainties persist, as you saw in the labor market, and we need to delve deeper into economic data to gain a clearer understanding of current trends and also future implications. So maybe that's all for today. Thank you for listening, and I think I will delve deeper for tomorrow, and I will discuss all these labor markets cases more deeply and more detailed.
Um, Hello, everyone. I will go next. I'm Anna from National Bank of Georgia, and I am a student at Global Forecasting School. I work on analyzing Czech national economy, and I currently am working on developing case A and case B scenarios. That includes I have updated macro economic analysis every day, and I follow the actions of the Czech National Bank. I will have a little introduction about Georgian teammates. Sergey, who is working on the UK, he is developing case A and case B scenario for the UK, and which also means staying always up to date on the Bank of England actions. Which Sergey will follow me and will dive a bit more deeper into his analysis, what he's working on. While Miriam, my co-worker, she's working. We have developed non-traded sticky price inflation index together, and currently she's working on applying this non-traded sticky price inflation index to other countries. Which we have currently for Georgia and Armenia, and we both use this measure for our current inflation analysis. And last but not least, at the end of today's seminar, I would like to give a floor to Haikas, who is working on developing a global projection model, which he will be discussing about more details. Maybe I suggest Sergey goes now first. Thank you.
Okay, thanks, Anna. Basically, what we were doing today and the last week was to prepare some case scenarios for the US under the Not of a Deal book. So I would like to share briefly what we came up with, what are our narratives for these risk scenarios, and what we think are the key risks for the United States, obviously. Um, just to briefly summarize our thinking in this regard, um, so on the one hand, we observed quite robust economic performance in the United States for several quarters already, and despite the fact that all the excess savings was already depleted. So now what we think and believe is that given the household balance sheet and given the wealth accumulation is still significant and supported by highest prices in the United States. So we think that exactly the wealth is the factor that drives this strong consumption, which leads or is the main source of the GDP growth there. Um, and on the other hand, we see quite a tight labor market in the economy, despite although we see some normalization in that regard, the tightness of the labor market declines to the pandemic level, but it still stays elevated, and this is especially reflected in the wage growth, which is also elevated. And obviously, this is costly for firms. So, and they reflect this in their pricing behavior. And as a result, these ticker prices, which we believe is a really good measure of underlying inflation and inflation expectations in general, they also are quite sluggish to decline, despite the fact that the core inflation and headline inflation are slowly converging towards the target. And um, and also the additional risk that we think is important is coming from the international markets, especially the transportation costs, which is again on the rise because of number of factors, and this we believe is going to contribute to the upside risks for the inflation. So in case A scenario, we condition this scenario on the strong demand side pressures persisting because of both supported consumption again fueling the growth, as well as the labor market remaining tight and the wage growth contributing to the inflation. And finally, these geopolitical tensions also contributing to upside risks to inflation. So obviously in this case, A indicates the situation which will require higher policy path to anchor inflation and inflation expectations. And in case of case B, we condition it on the one hand on the fact that labor market is, even though it's currently elevated, it's on its way to normalize and cool down. And if it's going to persist and if this trend continues, this will obviously support the disinflation process and wage growth will normalize. And on the other hand, we see some tight credit conditions, and especially given the high interest rates and high policy rate in the US, the credit growth is again declining and it's almost in the negative territory. And if the credit growth will decline, this will obviously in time, with some lags, have the effect on the demand, which in other words, it will weaken demand. And this additional will support the disinflation process in general. So in this scenario, we expect the faster pace with which the inflation will normalize. And obviously, this will require the lower interest rate or looser monetary policy than what's currently priced in the financial markets. So this was all about the case scenarios and what we were working on.
Thank you, Sergey, so much. I think exactly currently with the raising hate and uncertainty, that's what makes FPAS Mark II particularly important, because under Mark II we have this sort of risk management approach where we analyze case A and case B scenarios alongside with some taxonomy of shocks like case X, for example. And we saw during COVID-19 particularly that case X is very important for central banks as well. So maybe now Mariam will follow what she's working on, and then Haikas, thank you.
Thanks, Anna. Thanks for a very interesting discussion and comments from your sides. Basically, you mentioned already, Anna, that we are trying to look from everything from a post-market perspectives where we have this highly elevated uncertainty and nonlinear linkage there. So given this, as we all very well know, that mostly what FPAS Mark II world takes into account is carrying out policy analysis in a structured way by answering three fundamental questions that we all very well know. Where's the economy now? What are the underlying forces? And based on this, what the policymakers need to do to achieve their goals. And here we mean this anchoring inflation and inflation expectations. Here in this sense, while we need to think about these three major ingredients, we also need to think about, for sure, some different sort of tools and analysis, what we can apply there, which will help us. And here exactly in this regard, we think that we need better measures of underlying inflation measures, which is, from our perspective, is non-traded sticky price inflation. That's why we are trying to construct this measure not only for our countries. By the way, our countries, Georgia and Armenia, have constructed this measure just recently, and we have published our papers. And people who are interested in, they can just look into the papers and will find out some very interesting stories and the detail there. So exactly here, after our countries, we try to adopt this measure for different countries with which we are just watching, including, for example, in my case, New Zealand, also in Sergei's case, England, yeah, and for other GFS students' case, different countries. Also, we yesterday had a live stream on YouTube where we just introduced our non-traded sticky price inflation measure details to the people from the Bank of Thailand, and they're also interested in this. And so we are also thinking to construct this measure for the Thailand as well. It will be really interesting what kind of results we will get. So here we are in this process right now, and this will be like, I think that once we just finish for the Thailand and for countries that we are working on, then we can add other countries as well. So apart from the non-trade sticky price inflation measure, what's also very important for us, looking into some other types of topics, interesting topics for us. As a benchmark, we always focus our analysis on the United States due to the various facts, due to the fact that it has a richest data set, due to the fact that it's a biggest economy and it has a huge spillovers all over the world. And here we always start our analysis with the United States. And in this regard, we also, what we do is that we just carry out analysis of relative prices for the United States. And I'm working on that topic as well. What I mean here is that we try to look at the relative price levels of the US CPI into decomposed way. First, we look at the flexible price levels and we try to just look its development, how it converges or diverges to the sticky price level. And here what drives these different flexible prices and different products from sticky price basket to rise or to change. And in this regard, we've just finished first types of drafts where we've seen and already presented our work into the previous GFS seminars, where we just shortly discussed the issue of why we see the relative price increase in flexible prices over the sticky. And here we focused our analysis on the car market development. And in the upcoming Not Defective book, we will have this box as well, I guess. And there we will explain our perspectives in details. So in a nutshell, this is at this point the most important topics that I'm working on with my teammates. But here I would like to mention that there are several hot topics that we are very actively engaged, all GFS students. And yeah, I think that another hot topics are coming that we will soon start working and keep going on working on that. So that's all from me, Anna and Nahid.
Yes, let's add that me and Rudik had discussed like other uncertainties around US. So we know that BAA spread is very low, but it was interesting to go deeper into levels. And if neutral, for example, if we look at that data, we can see that two bond yields, government bond yields are in high levels, and also corporate BA corporate bond yields also are in high levels. And if natural rate is higher and it's coming from productivity, this will mean that maybe these high levels in corporate bonds are not that much costly for firms, but in other case, if this yield will remain in high levels, like in a longer time, that means that for firms it will be costly to attract funds, because if a natural rate, if they don't have productivity growth, that means that it's more, I can see, not easy to attract funds. Yeah, and Rudzik, maybe he will add something about these uncertainties around US.
Yeah, and Sergey talked also about some contraction in loanable funds, like for loans, and I want to continue your discussion about BA spreads, because like if we watch the leverages of businesses, we see contraction there also. However, this contraction comes from the bank's position, like contraction of financings from bank loans to businesses. But they still continue to get currently easy access to funds from like other debt securities, like corporate bonds. So in short run, we can see that the BA spread decrease is like giving them a little bit easy access for financing, for continuation of financing for their operations. The question remains whether it's backed up by productivity, longer run productivity growth or no. And on the top of that, recently we have seen a release of from Fed this summary of economic projections, and as we can see, the markets are expecting like higher PC inflation and a higher expected Fed rates path. And for this discussion, we have also watched the recent CPI release, and of course, compared to April, now it's like a little bit less inflationary. However, inflationary pressures remain in for shelter and some services, and here comes also the part of this discussion or financing of different like activities. If because like if there was a high level expectation for economic downturn or too much uncertainty, we would have one of the first things that would have been affected would be the housing sector, because economic downturn would have made them to double think their decision to continue to finance the mortgage market. However, still we can see that from that channel, people get financing for their mortgages, and this still continues. And the same goes for like consumption, particularly for services and so on, which also is incorporated in these market expectations. I think that's all for now.
Anna, you're on mute. You can't hear you.
Sorry. Thank you, Ridik and Anahit, for your introduction as well. And Mariam, could you just a bit elaborate more on what you're working on about? Like yesterday, you had a live seminar you mentioned about Thailand in like not trade stick price inflation. Could you please elaborate more, and then we give floor to Haikas?
Yes, thanks, Anna. As I mentioned, yesterday we had this live stream, and maybe I'll be short and I will just advertise our yesterday's seminar for people to look at and to watch us. What I can elaborate more is that we yesterday just introduced to the people from the Bank of Thailand the method and the details of how we constructed this measure and how long it lasted in our case, and also how this kind of the first experience will help us for other countries as well to construct this measure. By the way, I will just say here that overall for Georgia case, we just in 1 month we constructed this measure. And after this, after we just explained the importance of this measure to the people in our bank. Also, we are very actively using this in our policy analysis, in our, for example, committee meetings as well. This measure is always presented there, and it helps us to explain a lot of things in our economy. So yeah, maybe.
Thank you, Mariam. And you've also mentioned like this non-traded sticky price inflation is not one and first thing that we did. We have a lot of interesting projects going on, I would say, with developing this FPAS Mark II framework. And one of these interesting projects that I think not just case of Georgia and Armenia can use particularly, this will be useful for many central banks and many other economies. And Haikas has been working on this project, and maybe if he's willing, you can just give us more information.
Yes, Anna, thanks. Let me share presentation and go through. Yeah, go through the presentation. Yes. So as Anna said, this is the project on developing parts of FPAS Mark II. But here, what specific about this system of monthly projection models is that starting very soon, we are going to publish market reference scenario for the United States, as well as case A and case B scenarios. So which we are going to release each Sunday. So the announcement about these releases and upcoming updates will be you will know soon. And today I'm going to go through very briefly through the report which me and Doug did this morning. So it took us like a couple of hours to prepare the current updates on the US economy. And as our team members said, so they are analyzing their economies. They are trying to understand the narratives under case A and case B scenario. So collecting through the week, they are going to collect all this information, analyze what's going on in the economies of their interest. So one is analyzing the US economy, the Czech economy, so the UK, and every week we can update and get the market reference scenario as well as case A and case B scenario. So the system which we are using is a system of linear and non-linear models. So linear models, they are very important and useful for doing some tasks. Let's say do the historical analysis and do estimation, look at these kind of issues. But more like a real world is more non-linear and very important factors like non-linear Phillips curve or endogenous policy credibility, which affects on the inflation expectation, and all this like loss function approach. So all these non-linearities are very important to capture the much more complex world rather than the world through the lens of the linear models. Okay, and having this system, we of course dealing with these three important ingredients of the Mark II. Where is the economy now? What forces drive the economy, and what policy should do to achieve its objective. As I said, we have the endogenous policy credibility processing the model. In our other videos, you can find very deep discussion of this everything. So I'm going to be very brief on this and concentrate more on how we are getting the market reference scenario and build case A and case B scenarios. In this example, we are using the United States. Okay. We are having some analysis of what's happening in the United States. We are looking at some taxonomy of shocks to build the narratives of our case A and case B types of scenarios. So currently under case A, we are looking at the strong demand and some signals from the household wealth position, both in financial and non-financial asset. So all these factors and possibly the tight labor market we can apply to build the case A types of scenario and case B types scenario as a tightening of long condition. As Leah said, there are some signals from the labor market about the cooling. Unemployment rose to 4%, and etc. So, but okay, this case A and case B types of considerations are very important, but we built these case A and case B's relative to what? So the important component, one of the important components of the Mark II is come up with the scenario which markets expect, or the most probable scenario under which market is performing. So to do that, in our system we have bunch of information how to come up with market scenario. First, we use the survey of professional forecasters from the Philadelphia Fed. We are using the yield curve, 3 months, 6 months, 12, 24, 60, which is 5 years yields, and 10 years yields, to get the information on the expected path of the policy rate, as well as like using the expectation hypothesis of the interest rate. We are thinking about the term premiums, trying to understand where are the term premiums, so what factors affect the term premium. We have the information of the expected unemployment, as well as the PCE and core PCE from professional forecasters, which Philadelphia Fed realized 4 times per year, each quarter. And very important also information, like to track kind of the market expectation of the policy rate is the Atlanta Fed tracker. So today we used this the Atlanta tracker, half of the policy rate, to come up with the market reference scenario. So this figure exactly reproduces what the policy path according to the Atlanta Fed. And it's not surprisingly that under these assumptions, so we believe that under this expected path of the interest rate, markets believes a smooth landing scenario. And you can see here exactly that we have the smooth landing scenario. Unemployment gap goes negative, but not so strong. We cannot say that it's a recessionary or something else. And to get these scenarios, we are using, for the historical narrative, we are using the set of the linear models, and now for going deeper into the analysis, into the scenarios which have relevant policy implications. So we are using all this bunch of non-linearities. So you can see also the path of the Fed credibility under the market reference scenario. But the main idea here is that markets believe on smooth landing scenario. Now, kind of collecting the case A types of considerations. Now, I'm going to build the case A relative to this. But this is very important because we need to think about the risks relative to what markets expect, and think about market as at a high level. Think smooth landing scenario, right? And relative to that, now we are building case A and case B types of scenarios. Now case A, you can see the some tight demand conditions here, which accelerates kind of the unemployment gap, as well as increases the inflation higher compared to the market expectations, and as a result of that, policy has through the entire horizon has a higher cost. And to kind of bring inflation back to the target, you see that it's not as much smooth landing as we have in the case A types of scenario. Much more deeper recession here is needed because of the initial inflationary forces, as well as the loss of the credibility, right? Because inflation is higher, we have the higher demand, and the policy should be much more tighter, creating kind of not so deep, but kind of proxy recessionary scenario to bring back inflation to the target and to gain and result to the gaining of the credibility, because otherwise the credibility will move down more. And under case B types of scenario, so we have the negative demand side forces as well, which kind of initially drops unemployment to the negative territory, and it's kind of results into the initial decline of the inflation even below of the target, and to bring inflation kind of back to the target and stabilize the economy, policy follows the lower path compared to what markets expect, and at some moment creating the kind of positive output gap or unemployment gap to bring inflation back to the target. So that's kind of a high overview of what we have at this moment, and in the future, in the very nearest future, we will announce it very soon. Every week, we are going to publish in our website the updated market reference scenario and case A, case B scenarios for the US. Yes, that's it for now.
Thanks, Harikas. It was very interesting. Especially the market scenario was interesting for me in the sense of cumulative unemployment gap, which stays far above than zero, right? while we see that we don't have there the output gap as well, but it's kind of indication that cumulatively we are in the generalized excess demand conditions, right, throughout the longer term. And how it fits to the analysis, totally how it fits to the whole picture from your perspectives. I was curious in that.
Yeah, you mean, am I right? You are asking about, let's be fair again, okay? You are talking about this positive unemployment gap accumulative, right?
Yeah, it's like cumulative still, but it leads me to the expression that still there is staying some generalized excess demand conditions over the longer term.
No. Here, as I said, it's for me,
in case of unemployment,
it's a classic one of the
well, gap. Yeah, okay.
It's kind of classic smooth landing scenario. So it stays positive for some period of time, but it's declining, like stabilizing. We can say that there are no any positive or negative demand conditions, right? Then the cumulative reaches its peak at some point. Then it goes to the negative, but it's not so big. Okay, like maximum is minus 0.2 or something like that, 0.1, which I cannot call as a now recessionary scenario.
Yeah, I also was curious about the credibility part in case a scenario. You did not have this. You did not assume that it's Fed is gonna lose its credibility significantly right there. It's almost the same as.
There is some difference, and this difference, even this little difference in the credibility, it's significant on the results. Here, every time we need to think about the results and about how these things behave. For example, building the market reference scenario, like keeping the policy rate for the prolonged period of time, kind of following the Atlanta Fed tracker, right? Mm-hmm. And keeping some standard calibration on the credibility function, let's say with not so persistent, with less persistence, okay. It kind of crashes everything. Mm-hmm. Here we are at the margin on the calibration of the Fed credibility, and here it's very, very persistent. Fed has very persistent credibility. Mm. This is very specific for this particular period of time. When the new information release, or we will see another path or another initial conditions of the scenarios, we will change this persistence in the Fed credibility, and you will see the differences much more bigger. That's why it's very important here not to do the market reference scenario very mechanically. If I do in this particular example, very mechanically just putting that, and I have my understanding based on the historical narrative, which is the persistent coefficient of the credibility and how it affects to the formation on inflation expectations, and do not change at all the calibration for this simulation, you will see crash here. Mm-hmm. So policy will they will follow this path, and the credibility will fall like dramatically, and resulting to the spike in the inflation. So these nonlinear models, they are very dangerous, and they are very sensitive to the hard tuning things. So because here we actually take the policy path from the Atlanta Fed.
Okay. So, thanks, Haikas.
That's why.
I was also curious, why are you starting from 2022? Well, it's like your initial starting point is.
I am sorry. I'm sorry. Yeah.
Okay, there. Okay.
Some features, yeah. Mm-hmm.
Okay, thanks, Haikas. This was very interesting. Thank you. Maybe Anahit. Yeah.
Yeah, thank you guys for today's meeting. Thank you for sharing your work with us. We will meet in tomorrow in our usual daily meeting, and we will discuss, I think, deeper these topics, and maybe we will provide more information. So thank you very much. See you if Anna will add something.
Thank you all so much. Thank you, Haikas, for like explaining your project, and I think it really sounds interesting. We know how important, like you've mentioned, market reference point, and we know how important market reference point is in our FPAS Mark II framework, particularly. And I just want to also say that now that we are streaming on YouTube, tomorrow we have updating more about what we are working on and having a bit more deeper